It is a Sunday evening in Tampines. Darren is 32 years old. He is sitting at the kitchen table of the HDB flat he moved into 14 months ago. The flat took 4 years to build. He spent those 4 years imagining this moment, keys in hand, his own home, a new chapter. What he did not imagine was the spreadsheet open in front of him right now. 3 columns, 3 numbers. Credit card balance across 2 cards, $11,300. Renovation loan with DBS, $38,000 at 5.3% EIR per year. Car loan, a Honda Civic, 47 months remaining, $23,600. Total interest-bearing debt outstanding, $72,900. His take-home pay after CPF deduction is 4,620 Singapore dollars a month. His total monthly debt commitments, card minimums, renovation installment, car installment come to $1,480. He pays that, he buys groceries, he pays utilities, his phone, his EZ-Link top-up. He goes out maybe twice a month with his wife Priya. At the end of the month, there is almost nothing left. He has been employed for 8 years. He earns above the national median. He lives in public housing he bought with subsidies. He is not reckless. He has never taken a loan he could not service. And yet on this Sunday evening, Darren has more debt than savings by a ratio he does not want to calculate. This is not unusual. Unpaid credit card balances across Singapore hit a 10-year high of over $9 billion in late 2025. The spike in loan applications from Singaporeans aged 40 to 59 is 50% higher than in 2022. The reasons borrowers give, renovation, bills, household costs, consolidating earlier debts, are exactly what Darren is living. What Darren does not know yet is that his position is recoverable. Not just recoverable, transformable. The distance between where he sits tonight and $400,000 in invested capital is 8 years and a specific sequence of decisions. This is that sequence. The first thing Darren does wrong is he pays the renovation loan first. He set up the installment on autopay when the loan was approved. It costs him $1,080 a month. The interest rate is 5.3% EIR. He barely thinks about it. It comes out automatically. It is a fixed term. It feels like a mortgage. What he is not paying the same way are his 2 credit cards. Card 1. DBS Live Fresh. Balance of $8,200. He pays minimum each month, 3% of the balance, or $246. Card 2. OCBC. Balance of $3,100. He pays minimum, $93. $339 going to credit cards every month. The interest rate on both cards, 27.9% per annum, compounded daily. Here is what that actually means. On a balance of $11,300 at 27.9%, Darren pays approximately $262 in interest every single month. Of his $339 minimum payment, $262 goes to interest. $77 reduces the principal. At that pace, $11,300 takes over 14 years to clear. Not 14 months, 14 years, during which he pays approximately $22,500 in interest on a debt that started at $11,300. The renovation loan at 5.3% is almost 5 times cheaper than the credit cards at 27.9%. Darren is paying the wrong debt first. This is the avalanche principle, and it is not complicated. Order all debts from highest interest rate to lowest. Attack the highest rate first with every dollar above the minimum payments. Pay minimums on everything else until the most expensive debt is gone. Then, roll the entire freed payment into the next most expensive. The correct order for Darren is credit cards first at 27.9%, car loan second at approximately 7%, EIR, renovation loan third at 5.3%. The action here is immediate. Darren cancels the DBS automatic renovation loan overpayment and redirects it. He sets up a monthly standing order of $1,480, exactly what he was paying in total debt service, and directs every dollar above minimums to the credit cards. He calls DBS and asks what his renovation loan prepayment penalty clause says. In most Singapore renovation loans, there is none. He does not get a raise. He does not sell anything. He changes the order. Now look at the credit cards specifically, because this is where Darren can move fastest. The two cards carry a combined balance of $11,300 at 27.9%. Darren's immediate move is a balance transfer. DBS, OCBC, and UOB all offer balance transfer facilities. 0% interest for 6 or 12 months on the transferred amount, with an upfront fee of 1 to 2% of the transfer value. On $11,300 at 1.5% fee, that is $169 in fees to buy 12 months of 0% interest. During that 12 months, not a single dollar of his payment goes to interest. Every dollar reduces the principal. If Darren redirects $900 a month to this balance during the 0% window, by month 12, the balance is down to approximately $2,500. That remaining $2,500, he clears with a single payment from his emergency fund or the following month's surplus. Total interest paid on $11,300, $169 in transfer fee, instead of $22,500 over 14 years. The action. Darren applies for a balance transfer at his primary bank this week. He does not close the credit cards. That hurts his credit score. He cuts up the physical cards so he cannot use them and disables them in the mobile app. Balance transfer applications through DBS and OCBC are processed online in under 20 minutes. One condition. The balance transfer only works if he does not add new spending to the cards. Not a single dollar. If he does, the 0% window closes on the new spending and the 27.9% clock starts again. 18 months after that Sunday evening, the credit cards are gone. Darren is 33 years old. His debt is now two positions: renovation loan with $31,000 remaining, car loan with 36 months remaining, and approximately $17,000 outstanding. His monthly debt service is now $840, the renovation installment and the car installment. He has freed up $640 every month from where his debt payments were before. He now makes a decision that will define the next 7 years of his financial life. His wife Priya earns $4,200 take-home. Together, their household takes home $8,820 a month. Their essential expenses, groceries, transport, utilities, phone, insurance, run approximately $3,200. Debt service is $840. Household surplus before any optional spending, $4,780 per month. Most households in Singapore at this income level spend the surplus. Restaurant meals, weekend trips to Bali and Bangkok, a new sofa, a new phone. None of these purchases are wrong, but each one is a choice. Darren and Priya make a different choice. They agree to a household savings and investment rate of 50% of combined surplus. $2,390 goes to a specific plan every month. This is the number that changes everything. The plan has 4 parts. Each part has a specific Singapore vehicle, a specific number, and a specific reason. Part 1. Emergency Fund. Before any investment begins, they need 3 months of household expenses in cash. 3 months of expenses, $3,200 plus $840 in debt service, is $12,120. This goes into a DBS multiplier account or OCBC 360 account, which in 2026 pay between 3 and 3.6% on eligible balances. Not an investment, a buffer. No decision should be made from a position of financial fragility. They save $600 a month for this specifically. Emergency fund complete in just over 20 months. But they do not wait for the emergency fund to be complete before starting Part 2. They run both simultaneously. Part 2. CPF Special Account Top-Up. This is the single highest guaranteed return available to any Singapore citizen or PR, and it is the most underused. Darren is 33. His CPF Special Account currently earns 4% per year. The OA earns 2.5. The gap is 1.5 percentage points. On a balance of $40,000, that is $600 a year in difference. Money already sitting there, in his name, earning less than it could. But the top-up is different from the existing balance. Under the Retirement Sum Topping Up Scheme, RSTU, Darren can voluntarily contribute cash to his special account and receive full income tax relief on up to 8,000 Singapore dollars per calendar year. Priya can do the same. Here is what $8,000 at 4% over 30 years becomes. At 4% compounding, $8,000 doubles to approximately $16,000 in 18 years. Over 30 years, from age 33, that $8,000 becomes $25,970. And that is just 1 year's top-up. The relief on tax is immediate. Darren's income puts him in the 11.5% bracket for the portion above $80,000 in annual income. $8,000 in SA top-up saves him $920 in tax this year. They each contribute $8,000 to their own SA in January, the most efficient month. $16,000 a year flowing into 4% guaranteed accounts, generating $1,840 in annual tax savings between them. If Priya tops up Darren's SA and vice versa, they cannot because RSTU tax relief on family top-ups requires the recipient to have income below $8,000 a year. But if either of their parents does not work, the same tax relief applies to topping up a parent's RA. Darren's mother is 64 and retired. He can top up her retirement account with up to $8,000 and claim an additional $8,000 in tax relief on top of his own $8,000. $16,000 in relief annually from a single family. The action is simple and takes under 12 minutes on the CPF website on any weekday. Set up a gyro instruction to debit the SA top-up each January. It does not require a financial advisor. It does not require a brokerage account. It requires a SingPass login. Part 3. SRS Account. By year 2 of the plan, Darren opens an SRS account at DBS. Priya opens hers at OCBC. They each contribute 15,300 Singapore dollars per calendar year, the maximum for citizens and PRs in 2026. $15,300 reduces each person's assessable income by exactly that amount. At Darren's marginal tax rate of 15% on the portion of his income above $120,000 in annual assessable income, $15,300 saves him approximately $2,295 in tax annually. Across both their accounts, that is $4,590 in combined annual tax savings from SRS alone. Add the SA top-up relief, $16,000 at their blended marginal rate, and the SRS, $30,600 at their blended marginal rate. Total annual tax savings from CPF-SA top-up and SRS combined, approximately $6,430. Money that was going to IRAS now stays in their plan. But the SRS cash does not just sit there. An SRS account pays interest of 0.05%. That is essentially nothing. The entire point of SRS is to invest the money inside the account. Through their SRS accounts, Darren and Priya buy CSPX, the iShares Core S&P 500 UCIT SETF, listed on the London Stock Exchange. Why CSPX and not VOO or SPY? Because CSPX is Ireland-domiciled. Ireland-domiciled ETFs pay 15% withholding tax on US dividends under the US-Ireland tax treaty, compared to 30% for a US-domiciled ETF bought directly. On a portfolio growing to $200,000 with an annual dividend yield of 1.3%, that difference is 325 Singapore dollars a year in tax not paid. Over a decade, $3,250. And there is no US estate tax exposure on an Irish domiciled fund, which matters for anyone holding over $60,000 in US-sided assets. CSPX has a total expense ratio of 0.07% per year. On $100,000, that is 70 Singapore dollars annually in management fees. Priya adds VWRA, the Vanguard FTSE All-World Accumulating ETF, also London-listed, Ireland-domiciled, 4,000 companies across 50 countries, TER of 0.22%. Between them, they hold the S&P 500 and the entire world market. Singapore has no capital gains tax. When CSPX doubles in value and they sell, they owe zero tax on the gain. This is not a loophole, it is the design of the system. They invest through Interactive Brokers, the broker with the lowest transaction costs for LSE-listed ETFs among Singapore investors. Approximately 2 Singapore dollars per LSE trade. On 12 trades a year, 24 Singapore dollars in annual brokerage fees total. They invest $750 each per month into their SRS accounts, 1,500 total, and immediately transfer each month's contribution into CSPX and VWRA. Monthly regular savings plan, not timing the market, not watching charts. Part 4. The car. The car is destroying the plan faster than anything else. Darren bought a Honda Civic 22 months ago. The car cost 163,000 Singapore dollars all in, the open market value plus COE Cat A at approximately $126,000 at the time, plus ARF and registration. His monthly installment is $735. Insurance is $240 a month. Petrol and parking another $180. Total cost of car ownership, 1,155 Singapore dollars per month. The Honda Civic costs $14,000 a year to run, insure, and service. The loan runs for another 36 months from today. At month 37, when the car loan is fully paid, Darren and Priya make a decision. They do not renew the COE for another 10 years. They sell the car when it comes off loan. They switch to Grab, MRT, and a Grab car corporate account for late nights. Their combined transport spending after selling the car, $340 a month. The $815 monthly difference goes into CSPX via SRS. Over 10 years, $815 a month invested at an assumed 7% annual return compounds to $134,720. That is not the cost of the car, that is the cost of the car decision repeated over a decade. The action for Darren is to set the calendar reminder now. 36 months from today, arrange the car valuation. Used car prices in Singapore peak between 8 and 12 years of age of the vehicle because buyers want enough remaining registration years to justify the purchase. Sell at the right moment in the depreciation curve. By age 38, 5 years into the plan, this is where Darren and Priya stand. Credit cards, zero. Renovation loan, fully paid off 20 months ago when they redirected the freed car installment payment at month 37. Car loan, zero. Car sold. CPF Special Accounts combined, approximately $104,000 between them, growing at 4%, compounding untouched. SRS accounts combined, they have contributed $15,300 each per year for 4 years, $122,400 total contributed. At a blended annual return of 8% on their CSPX and VWRA holdings, the SRS portfolio is worth approximately $141,300. Emergency fund, $16,000 in DBS multiplier at 3.4%. Total net worth outside their HDB flat, approximately $261,300. Darren is 38, Priya is 37. They own a flat with a current resale value of $550,000 and an outstanding HDB loan of approximately $290,000. Their monthly household surplus, now with zero consumer debt, no car, is $3,440. They increase their SRS monthly contributions to $1,200 each. They also start directing $500 a month to their CPF ordinary accounts above the mandatory employer-employee contributions, which goes into CPFIS, specifically the STI ETF listed on SGX, eligible for CPFIS-OA with a 3 to 4.5% trailing dividend yield, available through DBS or OCBC as CPFIS agent banks. Here is the number that matters. At age 40, Darren does two things that accelerate the second half of the journey. First, he makes a single CPFSA top-up of $22,000, the remaining room before he hits the full retirement sum of $220,400 in 2026. His SA has been compounding since 33, but there is still room. $22,000 at 4% for 25 years becomes $59,000. A single decision on a single afternoon. Second, Priya gets a promotion. Her new take-home is $5,300. They choose not to upgrade their lifestyle. The additional salary minus their existing commitments, approximately $900 more per month, goes entirely into CSPX via cash brokerage outside SRS. They open an interactive broker's account jointly. $900 a month, monthly DCA, no market timing, no stock picking. The renovation has already been paid. The car is gone. The credit cards do not exist. The HDB loan is the only remaining debt, and it services itself through CPFOA mandatory contributions at 2.5% interest, among the lowest mortgage rates available to anyone in Singapore. By age 40, 8 years after that Sunday evening spreadsheet, Darren and Priya's financial position looks like this. CPFSA combined, both accounts at or approaching the full retirement sum of $220,400 each. Combined CPFSA balance, approximately $268,000, growing at 4% compounded, generating approximately $10,720 per year in guaranteed interest. Untouched. SRS accounts combined, approximately $256,000. Invested in CSPX and VWRA, reflecting 8 years of contributions plus compound market growth at an assumed 8% blended return. Cash brokerage CSPX account, approximately $42,000 after 2 years of $900 monthly contributions at 8% return. Emergency fund, maintained at $20,000 in high-yield savings. Total investable assets outside their HDB flat, approximately $586,000. HDB flat, current estimated resale value $630,000. Outstanding loan, approximately $230,000. Equity, $400,000. But Darren does not count this as accessible capital. It is the family home. Total financial capital that is liquid or near liquid, 586,000 Singapore dollars. They are 40 and 39 years old, from $72,900 in consumer debt at 32 to $586,000 in investable capital at 40. 8 years. No inheritance, no cryptocurrency, no lucky stock pick, no second property, no rental income. Now step back and look at what actually happened. The first thing that happened is sequencing. Darren and Priya paid the most expensive debt first, not the biggest debt first. That decision alone, redirecting payments to the 27.9% credit cards before the 5.3% renovation loan, saved approximately $15,000 in interest over the first 18 months. $15,000 they invested instead. The second thing that happened is tax leverage. Every year for 8 years, they each contributed $8,000 to SA under RSTU and $15,300 to SRS. Over 8 years, that is $186,400 in combined CPFSA contributions and $244,800 in SRS contributions. The tax relief generated over 8 years at their blended marginal rates totaled approximately $51,000. $51,000 that stayed in their accounts instead of going to IRAs. Invested at 8% over the 8-year period, that $51,000 became approximately $94,000 in final portfolio value. The third thing that happened is the car. Selling the car at month 37 and not replacing it freed 1,155 Singapore dollars per month, 815 after replacing transport costs with public transport and Grab. Over the 5 remaining years of the plan, at 8% return, that decision is worth $81,000. The fourth thing that happened is what they did not do. They did not upgrade from a 4-room to a 5-room. They did not buy a condo. They did not purchase a second property and pay 30% ABSD. They did not buy a new phone every 12 months. They did not take a business class flight to Tokyo. Every one of these decisions is available to someone earning their combined income. They just chose differently. This is what the math looks like when you chart the components. The credit card elimination through balance transfer saved $15,000 and freed $339 a month from month 2 onwards. The SA top-ups at 4% over 8 years turned $64,000 of contributions into approximately $87,000 in SA value specifically attributable to their voluntary top-ups on top of mandatory contributions. The SRS invested in CSPX and VWRA grew from $122,400 to $256,000 in 8 years at 8% assumed return. The car decision freed $81,000 over 5 years that would otherwise have been spent on depreciation, insurance, petrol, and COE. The tax relief kept $51,000 inside the household that would have gone to IRAS. 5 separate decisions. None of them required unusual intelligence, high risk tolerance, or financial expertise beyond what is publicly available on the CPF board website, the IRAS website, and a single evening spent reading about Ireland-domiciled ETFs. There is one thing Darren gets wrong during the 8 years, and it is worth knowing what it is. In year 3, a colleague tells him about a Singapore REIT trading at a 15% discount to its book value. The colleague has done thorough research. The fundamentals look compelling. Darren puts $30,000 into it through his cash brokerage account outside SRS, using money he had been accumulating for the next SA top-up. The REIT distributes dividends, but the unit price falls 17% over the following 14 months as interest rates stay elevated and commercial property in the subsector struggles. He sells at a loss of 5,100 Singapore dollars, including dividends received. The lesson is not that REITs are bad. The lesson is that $30,000 in a single stock or REIT is a concentration risk that his overall plan does not need. The plan already has market exposure through CSPX and VWRA. The CPFSA contribution he skipped that year to fund the REIT at 4% compounded for 17 remaining years would have been worth $15,600 at retirement. The REIT cost him $5,100 plus $15,600 in opportunity cost, $20,700. Active stock picking inside a plan built on index funds and guaranteed CPF returns is not enhancement. It is noise. The accounts that do not require any decisions, the SA compounding at 4%, the CSPX accumulating dividends automatically inside the ETF, are the ones that build the base. The ones that require decisions are the ones where mistakes live. The action is a rule. No single position outside of CSPX or VWRA in the SRS or brokerage accounts exceeds 10% of total investable assets at any time. Not because other investments cannot work, because 10% concentration cap is the difference between a mistake and a setback. Darren's REIT would have been a setback at 3% of portfolio. At 6%, it was a setback and a disruption to the SA contribution schedule. The people who look at Darren and Priya's position at 40 and call it exceptional are wrong. Their combined household income over the 8 years averaged approximately $11,500 per month gross, above median but not in the top 10%. They live in a 4-room HDB flat in Tampines, not a condominium in District 10. They did not start with family money, inheritance, or an unusual financial background. What they had was a spreadsheet on a Sunday evening in Tampines, and the willingness to sit with that spreadsheet long enough to understand what was in it. The $72,900 in debt was not a hole they fell into through bad character. It was the standard outcome of getting married in Singapore in your late 20s, renovating a newly handed over BTO, buying a car because it felt necessary, and using credit cards as the gap filler for the months when the installment payments consumed too much of the salary. Almost every Singaporean household at that life stage carries some version of this stack. The renovation loan is nearly universal among new HDB owners. The car comes along for a significant portion. The credit card balance accumulates because at 27.9% you do not feel the accumulation, you feel the minimum payment, and the minimum payment feels manageable. What changes the outcome is not what happens between 32 and 40. What changes the outcome is what is understood on that Sunday evening in Tampines about the difference between paying the renovation loan first and paying the credit cards first. $1,500. That is the approximate monthly difference in interest costs between paying the cheapest debt first and paying the most expensive debt first, on a debt stack the size of Darren's. Over 12 months, $18,000. Over 2 years of paying down the wrong debt in the wrong order, $36,000 in excess interest that never had to be paid. $36,000 is the SA top-up for 4.5 years. At 4% compounded from age 33 to 65, those 4.5 years of top-ups are worth 142,000 Singapore dollars at retirement. The debt did not cost Darren and Priya $72,900. Paying it in the wrong order at 27.9% while putting off the SA top-ups would have cost them $142,000 by 65. One spreadsheet on one Sunday evening, one correct ordering of the columns. You probably know the feeling. The end of the month comes and the number in the account is smaller than you expected, and you are not sure exactly where it went. It did not go to anything specific. It went to the system, the minimums, the monthly commitments, the $1,200 that left your account on the 3rd of every month, and you stopped thinking about because it was automatic. Darren and Priya did not earn their way out of that feeling. They thought their way out of it. On a Sunday evening in Tampines, with a spreadsheet and a browser tab open to the IRAS website and another to the CPF login page. The debt is not the destination. The debt is just the starting point of a story that most people assume goes in one direction. It does not have to. What does your spreadsheet look like right now? And which column have you been paying first? If this video changed how you see it, like, subscribe, and share it with the person in your life who is making monthly minimum payments on a credit card balance they have had for 3 years.